Imagine waking up tomorrow to find that nearly twice the entire US economy had simply vanished from the books. Not through some catastrophic collapse, not through hyperinflation or default, but through a financial sleight of hand so subtle that most Americans don't even know it's happening. We're talking about $38 trillion, a number so massive that if you stacked it in $100 bills, the pile would reach beyond the moon. This isn't science fiction, and it isn't a conspiracy theory. It's the carefully orchestrated reality of how the United States government is quietly making its debt obligations disappear, and the implications for your savings, your retirement, and your children's future are staggering. The mechanisms being used are so sophisticated, so buried in financial jargon and bureaucratic procedures, that even seasoned economists struggle to explain them in simple terms. But make no mistake, what's happening right now will fundamentally reshape the American economy for generations to come, and understanding it might be the difference between financial security and devastating loss. The story of America's $38 trillion debt erasure begins not in the halls of Congress or the Federal Reserve, but in the aftermath of the 2008 financial crisis, when the government learned a powerful lesson about modern monetary mechanics. When Lehman Brothers collapsed and the global financial system teetered on the brink of complete meltdown, the Federal Reserve discovered it could create trillions of dollars with nothing more than keystrokes on a computer. They called it quantitative easing, a term deliberately designed to sound boring and technical. But what it really meant was that the central bank could purchase government debt using money that didn't exist until the moment they decided it should. Between 2008 and 2014, the Fed's balance sheet exploded from less than $1 trillion to over $4 trillion, essentially creating money out of thin air to buy treasury bonds and mortgage-backed securities. The radical part wasn't just the money creation itself. It was the realization that this debt, once purchased by the Fed, essentially disappeared from public concern because the government owed it to itself. When the Treasury pays interest on bonds held by the Federal Reserve, that interest gets returned to the Treasury as profit from the Fed's operations. It's a financial Ouroboros, a snake eating its own tail. And it opened up possibilities that previous generations of policymakers would have considered impossible or reckless. I hope you're doing well. If you like this video, please subscribe to my channel and hit the bell icon for more video notifications. Understanding what comes next is crucial because the techniques being used to manage this debt will affect everything from the interest rate on your mortgage to the purchasing power of every dollar in your wallet. Fast forward to today, and the scale of what's happening makes those early quantitative easing programs look like practice runs. The COVID-19 pandemic provided the perfect cover for an unprecedented expansion of this debt monetization strategy. In just 2 years, from 2020 to 2022, the federal government spent over $6 trillion on pandemic relief programs, stimulus checks, business loans, and expanded unemployment benefits. The national debt, which had taken over 2 centuries to reach $23 trillion, jumped to over $31 trillion in less than 3 years. But here's where the magic trick happens. A significant portion of this new debt was purchased directly by the Federal Reserve, which expanded its balance sheet from $4.2 trillion in early 2020 to nearly $9 trillion by 2022. This means that roughly $5 trillion of government debt was effectively purchased with newly created money. The Treasury issued bonds, the Fed bought them with digital entries in the banking system, and suddenly the government had trillions to spend without having to find lenders willing to part with their actual savings. The public debate focused on whether the stimulus was too much or too little, whether checks should have been bigger or more targeted, but almost no one discussed the fundamental transformation in how this spending was being financed. The second major mechanism for making debt disappear is even more subtle and involves something called financial repression, a term coined by economists to describe policies that force savers to accept returns below the rate of inflation. When the government keeps interest rates artificially low while inflation runs hot, the real value of outstanding debt shrinks automatically. Think about it this way. If you owe someone $100,000 and inflation is running at 7% per year while you're only paying 3% interest, the real burden of that debt is declining by 4% annually. For the government, which owes over $30 trillion, even a few years of this dynamic can erase trillions in real debt burden without anyone technically defaulting or the debt number on paper changing much. The COVID inflation surge that began in 2021 and peaked in 2022 with inflation rates hitting 9%, while Treasury yields remained relatively suppressed, was a masterclass in this technique. While Americans suffered from rising prices at the grocery store and gas pump, the government was quietly reducing the real value of its debt obligations by hundreds of billions of dollars every quarter. The Fed's initial insistence that inflation was transitory kept interest rates low even as prices soared, maximizing this wealth transfer from creditors to the government debtor. By the time the Fed finally began raising rates aggressively in 2022, significant damage to the real debt burden had already been accomplished. The third piece of the puzzle involves international monetary dynamics and the dollar's role as the world's reserve currency, a privilege that allows the United States to export its inflation to other countries. When the Fed creates trillions of dollars to buy government debt, those dollars don't just stay in America, they flow around the world through trade, investment, and financial markets. And because so much international commerce is denominated in dollars, other countries have no choice but to accept them and hold them as reserves. This means that when America inflates its money supply, the inflation gets diluted across the entire global economy rather than being fully absorbed domestically. Countries that have accumulated massive dollar reserves, like China with over $1 trillion in U.S. Treasury bonds, Japan with a similar amount, and dozens of other nations, are essentially trapped. If they try to sell their Treasury holdings in large quantities, they would crash the bond market and destroy the value of their remaining holdings, so they are forced to continue accepting dollars even as the purchasing power of those dollars is being deliberately eroded. This dynamic allows the U.S. to run deficits that would be impossible for any other country, because the costs are partially borne by foreign holders of dollars and dollar-denominated assets. It's a form of seigniorage, the profit governments make from issuing currency, but on a global scale that few Americans fully appreciate. The fourth mechanism is perhaps the most concerning, because it involves changing the very metrics by which we measure debt sustainability. Over the past decade, there's been a subtle but significant shift in how economists and policymakers talk about government debt. The traditional measure was debt to GDP ratio, comparing total government debt to the size of the economy. By this metric, the U.S. passed the dangerous 100% threshold around 2012 and now sits at roughly 130% when you include all federal debt, or about 100% if you only count debt held by the public. These are levels historically associated with debt crises, especially in developed economies. But increasingly, the focus has shifted to debt service costs, the actual interest payments as a percentage of GDP or government revenue. The argument goes that as long as interest payments remain manageable, the total debt stock doesn't matter as much. This conveniently ignores that interest rates have been at historically unprecedented lows for the past 15 years, artificially suppressing debt service costs. As rates have risen since 2022, debt service has exploded to over $600 billion annually and is projected to exceed $1 trillion within a few years, becoming one of the largest items in the federal budget. But by the time the public fully understands the crisis, the debt will be so large that conventional solutions will be impossible, which is exactly the point. When default or massive spending cuts become unthinkable, the only remaining options are inflation and financial repression, which is what we're already seeing. The fifth element involves the banking system and how regulatory changes have made financial institutions captive buyers of government debt. After the 2008 crisis, new banking regulations under Basel III and the Dodd-Frank Act required banks to hold much larger capital cushions and maintain portfolios of highly liquid, safe assets. Treasury securities are defined as the safest assets, with zero risk weighting in bank capital calculations. This created massive artificial demand for government debt from the banking sector, which had little choice but to load up on treasuries to meet regulatory requirements. When you combine this with the Fed's practice of paying interest on excess reserves, you create a system where banks are incentivized and often required to channel deposits into government debt rather than lending to businesses and consumers. This is why we've seen the strange phenomenon of banks sitting on trillions in excess reserves, even while many businesses struggle to get loans. The banks aren't hoarding cash out of fear necessarily. They're responding rationally to a regulatory structure that makes buying government debt more profitable and less risky than traditional lending. This regulatory capture of the banking system ensures a steady stream of buyers for Treasury securities regardless of market conditions, effectively creating a permanent bid under the government bond market. The sixth mechanism is the most invisible to average Americans and involves the Social Security Trust Fund and other government trust funds, which nominally hold about $6 trillion in assets. These trust funds, which are supposed to represent dedicated savings for future obligations, are invested entirely in special issue Treasury securities. In other words, when you pay Social Security taxes, that money doesn't go into an investment portfolio of stocks, bonds, and real estate that might grow in value. Instead, it's immediately spent by the general government and replaced with IOUs in the form of these special Treasury securities. When Social Security runs a surplus, as it did for decades, that surplus is used to buy these bonds, financing general government operations. Now that Social Security is running deficits as baby boomers retire, those bonds need to be redeemed, but there's no pile of money anywhere. The government has to borrow new money or raise taxes to pay back the trust funds, which are simply another arm of the government. It's an accounting fiction, but one that has allowed roughly $6 trillion in government spending over the decades to be financed without appearing to increase the public debt. As these trust funds are depleted over the coming decades, the debt will have to be refinanced into public hands, but by then it will be presented as a crisis requiring dramatic action, rather than the predictable result of decades of accounting gimmicks. The seventh and perhaps most sophisticated element of this debt erasure involves the maturity structure of government debt and the rollover process. The Treasury has deliberately shortened the average maturity of outstanding debt over the past 15 years, meaning more debt comes due and needs to be refinanced every year. During the period of ultra-low interest rates, this seemed clever because it allowed the government to lock in low borrowing costs in the short term. But it also created a situation where enormous amounts of debt issued during the zero interest rate period is now rolling over at much higher rates. In 2024 and 2025, over $7 trillion in Treasury securities will mature and need to be refinanced. The government has been replacing low-rate debt with higher-rate debt, which is why interest costs are exploding even though the total debt stock is growing more slowly than during the pandemic. But here's the twist. Because so much debt needs to be rolled over constantly, the government has maximum flexibility to change the terms through inflation. If you issued a 30-year bond in 2020 at 1% interest, that creditor is locked in for 3 decades getting destroyed by inflation. But if you issued a 2-year bond, it matures quickly, and while the government has to pay higher rates when refinancing, the inflation has already eroded much of the principal's real value. The short maturity structure means the government can quickly adjust to market conditions, while ensuring that long-term creditors get trapped in low-yielding instruments during inflationary periods. The eighth mechanism involves international monetary policy coordination that's rarely discussed in public. The major central banks, the Federal Reserve, European Central Bank, Bank of Japan, and Bank of England don't operate independently, even though they're technically separate institutions. They coordinate through regular meetings, currency swap lines, and implicit understandings about monetary policy. When the Fed launched quantitative easing, it wasn't long before other central banks followed suit. When the Fed began tapering, others eventually followed. This coordination serves multiple purposes, but one crucial function is preventing any single country's debt monetization from becoming too obvious. If only the Fed were creating trillions of dollars to buy government debt, the dollar would collapse relative to other currencies. But when all major central banks are doing similar things, the relative exchange rates stay fairly stable, masking the underlying devaluation. It's a race to the bottom where everyone crosses the finish line together, so no one appears to have lost. The Japanese have been particularly aggressive with this, running debt-to-GDP ratios exceeding 250%, and having the Bank of Japan own nearly half of all Japanese government bonds. The fact that Japan hasn't collapsed provides cover for other countries to push further down this path. But it ignores that Japan's situation is unique in ways that are not replicable for countries like the US that run large trade deficits. The ninth element is the shift toward modern monetary theory thinking among policymakers, even those who wouldn't explicitly endorse the label. MMT argues that governments that issue their own currency can never involuntarily default because they can always create more money to pay debts denominated in that currency. The only real constraint, according to MMT, is inflation, and even that can be managed through taxation and other policies. While mainstream economists still reject MMT's more extreme claims, its core insights have quietly infiltrated policymaking. The massive pandemic spending with minimal immediate concern for how it would be financed, the persistent calls for more infrastructure and social spending despite already high deficits, and the blasé attitude toward trillion-dollar annual deficits all reflect an underlying acceptance that debt doesn't matter in the traditional sense. Politicians have learned that they can spend enormous sums. The Fed will accommodate by keeping interest rates low and buying bonds if necessary, and the consequences in terms of inflation can be blamed on other factors like supply chains, corporate greed, or foreign conflicts. This creates a moral hazard where fiscal discipline becomes politically impossible because any politician who advocates for balanced budgets will be outspent by those promising free benefits financed by monetary magic. The 10th mechanism involves the tax code and how inflation interacts with progressive tax brackets, a phenomenon called bracket creep. When inflation runs high but tax brackets aren't fully adjusted, people get pushed into higher tax brackets even if their real income hasn't increased. This means the government automatically collects more tax revenue as a percentage of GDP during inflationary periods without having to vote for explicit tax increases. Similarly, capital gains taxes aren't adjusted for inflation. So if you bought a house for $200,000 and sell it 20 years later for $400,000, you might think you've doubled your money. But if inflation was 50% during that period, your real gain is much smaller. Yet you'll pay taxes on the full nominal gain, meaning you're partly paying taxes on inflation rather than real returns. This inflation tax is highly regressive because it hits savers and fixed income retirees hardest while debtors, including the biggest debtor of all, the government, benefit. The fact that these tax provisions aren't indexed to inflation isn't an oversight. It's a feature that allows the government to automatically increase its revenue extraction during the very periods when it is using inflation to reduce debt burdens. The 11th mechanism involves pension funds, insurance companies, and other institutional investors that are required by law or regulation to hold large quantities of government bonds. State and local pension funds, which have unfunded liabilities exceeding $5 trillion, are typically required to invest a significant portion of their assets in government securities. Insurance companies must hold bonds to match their long-term liabilities. These institutional investors represent trillions in permanent demand for government debt, regardless of the yields offered. When you combine the Fed's buying, the banking sector's regulatory requirements, foreign central bank reserve accumulation, and institutional investor mandates, you create a market for government debt that's substantially insulated from normal market discipline. A private company or individual issuing debt in such quantities would face rising interest rates, as lenders demanded compensation for the risk. But the government has essentially captured the entire financial system to ensure cheap, reliable financing for its deficits. This financial repression has devastating effects on savers and retirees who find themselves unable to generate adequate returns, effectively subsidizing government borrowing through reduced returns on their life savings. The 12th element is demographic and involves the intergenerational transfer of debt burden. The current debt being accumulated will have to be serviced and eventually repaid by future generations, who had no say in the spending decisions that created it. But because those future taxpayers aren't yet politically organized, and many haven't even been born, their interests are completely ignored in current policy debates. Politicians can promise benefits to current voters, finance them with debt, and retire long before the bills come due. This creates a systematic bias toward debt accumulation that democratic systems have proven unable to counteract. The $38 trillion in current debt represents roughly $285,000 per federal taxpayer, or about $114,000 per person in the entire country, including children. A family of four's share of the national debt is approaching $500,000, a mortgage-sized obligation they had no part in creating. The only ways this debt burden can be addressed are economic growth that expands the tax base, explicit default, or inflation that erodes the real value. Given that politicians will never willingly choose default and that growth prospects are limited by aging demographics and productivity challenges, inflation becomes the path of least political resistance, which explains why it's the preferred method of debt reduction. The implications of this quiet debt erasure are profound and will reshape American society in ways that are only beginning to emerge. For savers, the message is clear. Holding cash or traditional bonds is a losing strategy when financial repression is government policy. Real assets like property, commodities, and equities become essential inflation hedges. But this also means asset prices get bid up to levels that make them unaffordable for younger generations trying to build wealth. For retirees on fixed incomes, the combination of low interest rates and high inflation is devastating, destroying the purchasing power of savings that were supposed to last for decades. For younger workers, the prospect of inheriting an economy burdened with massive debt, degraded currency, and potentially higher explicit taxes creates legitimate concerns about generational equity. The social contract that previous generations could expect, where hard work and savings led to security and prosperity, is being fundamentally altered. Perhaps most concerning is that once this path is chosen, it becomes almost impossible to reverse without triggering a crisis. Returning to sound money principles would require either defaulting on obligations, cutting spending dramatically, raising taxes substantially, or some combination that would be politically catastrophic. So the debt monetization and inflation continue, each round requiring more extreme measures to maintain the illusion of sustainability, until eventually the system breaks in ways that are difficult to predict, but easy to fear. The $38 trillion debt erasure is not a one-time event, but an ongoing process that will define American economic reality for decades to come. And understanding it is the first step toward protecting yourself and your family from its consequences.